Welcome to the deep dive. Today, we're plunging into a truly fascinating and, frankly, explosive story, Locafy Limited. That's ticker LCFY.
Yeah, an Australian microcap that just saw this astonishing pre-market surge, over 290% on June 27th, 2025.
It's absolutely the kind of move that grabs everyone's attention, makes you sit up and ask, what just happened. By the end of this deep dive, you'll hopefully have a much clearer picture of the company's core business, its management, financials, market position, the risks involved, and crucially, what its current valuation really implies.
Exactly, because the market is grappling with this pivotal question right now.
Mhm.
Has Locafy, which, let's be honest, has been historically unprofitable, has it finally unlocked a path to dominate a slice of that huge US $700 billion SEO market with its AI-ready tech?
Or is this just, a speculative fever dream, a bit of market euphoria?
That's what we need to dissect. Substance versus sentiment will help you understand what's really going on beneath those headlines.
Okay, so what we're going to unpack today is a comprehensive fundamental analysis of Locafy Limited. It's a software as a service company, SaaS, based over in Perth, Australia.
And all the data, the metrics, assessments, everything we're discussing is current as of today, June 27th, 2025.
Right. Previous close, the share price was $2.55, and then boom, this massive pre-market move. But here's where it gets really interesting, I think. The reason behind it all.
The catalyst.
Exactly. A press release, 8:00 a.m. ET today. It details a strategic partnership.
With an unnamed partner, though, that's key. Described only as a leading U.S. online reputation and review management platform.
Right. And Locafy is set to syndicate business listings for about 10,000 of this partner's high-value professional service provider clients.
But the market reaction,
Yeah.
it's way beyond just adding 10,000 users, isn't it?
Oh, absolutely. It feels like a fundamental shift in perception. Locafy very successfully repositioned itself, framing its tech as AI search-ready.
Claiming its proprietary landing pages are consistently cited by the big AI platforms ChatGPT, Gemini, Perplexity.
So the big question everyone's asking is, what does this all mean for investors? Let's get into it.
Business analysis.
Okay, let's start by unpacking Locafy's core business. What do they actually do?
Well, fundamentally, they're a marketing technology SaaS company, mostly subscription-based. They have two main revenue streams. There's the publishing segment that's revenue from their own sites, like Hot Frog,
Okay.
and then the SEO agency segment, which is actually their main driver historically,
Yeah.
optimizing content for third parties.
Right. And this new partnership adds another layer, doesn't it? This channel partner approach.
Exactly. Highly scalable. It creates this tiered revenue stream from those 10,000 new users, plus, importantly, significant upsell potential down the line.
And their product suite. What's the tech behind it?
Yeah, that's fascinating. The centerpiece is what they call AI-ready landing pages. These are proprietary, programmatically generated pages, optimized not just for traditional local search, but crucially for these new generative AI platforms.
And they claim they're being cited as primary sources by ChatGPT, Gemini.
That's the claim. And it ties into their core differentiator, entity-based SEO solutions.
Okay, what does that mean exactly? Entity-based.
It means going beyond simple keywords. It's about understanding concepts, relationships between things, much like how modern search engines and AI models actually comprehend information.
So products like Keystone and Article Accelerator are built on that idea.
Correct. And they also recently introduced Localizer back in February 2025, specifically to boost local search visibility.
Got it. Now, Locafy, we said it's a microcap, tiny market cap before today, around $3.5 million.
Yeah, very small, aiming for a slice of that massive US $700 billion global SEO pie.
And it's a lean operation, only 26 employees.
Which makes that channel partner strategy absolutely critical, doesn't it?
Absolutely. It lets them instantly add around 10,000 U.S. business users. That kind of scale would be impossible, or at least prohibitively expensive, trying to do it through direct sales.
So boiling it down, what's their primary value proposition?
I think it's about delivering an affordable, automated, and scalable digital marketing solution aimed squarely at SMBs, small and medium businesses, and multi-location brands.
And promising quick results. Improvements in search rankings within weeks.
That's the promise. Their vision, they say, is the ultimate location-based digital marketing solution.
Achieved through those syndicated listings, the AI-ready pages, and their own tech for dominating, like the local map pack results.
And if we zoom out, look at the bigger picture, Locafy is sitting right at the intersection of some pretty powerful market trends, wouldn't you say?
Oh, definitely. The global SEO software market itself is projected to hit, what, $265 billion by 2034, growing at over 13% CAGR.
And their specific niche, local SEO software, is growing even faster, projected 20% CAGR, hitting nearly $60 billion by 2032.
That's a huge tailwind. And then you layer on the AI integration that's fundamentally reshaping digital marketing.
AI-driven strategies making up 75% of marketing by 2025.
That's the prediction. And it's arguably the most important tailwind for Locafy right now.
Plus the rise of voice search, conversational search.
Right. Voice commerce sales hitting $164 billion worldwide by 2025. And Locafy specifically addresses this with patented tech, including speakable schema code.
And finally, just the dominance of near-me searches, hyperlocal.
Which has surged over 400% in 2 years. That's the bedrock of their business, really.
Okay, but it's not an empty field. The competition must be fierce.
Oh, it's incredibly fragmented and intensely competitive.
Yeah.
We can't just make superficial comparisons to, say, BuzzFeed or something unrelated.
No, definitely not. Who are the real players here?
You've got formidable companies like Yext, Reputation.com, SEMrush, then specialized tools like BrightLocal, MozLocal.
Newer automated platforms, too, like Merchant.
Exactly. And of course, just thousands of traditional digital marketing agencies offering local SEO services.
And the regulatory environment, things like Section 230.
That plays a role, too. Potential reforms to Section 230 in the U.S., which deals with platform liability for user content, plus growing global focus on data privacy. These things impact any company handling user data.
So, despite this huge market, there are real barriers to entry, right? Intense competition, needing specialized tech know-how.
And just the tight budgets most small businesses operate under.
So how does Locafy actually navigate these?
Well, you could argue their entire business model is designed to address those barriers directly. The platform's automated, so it tackles the tech expertise gap. It's positioned as affordable for those SMB budgets, and it's scalable through partnerships, helping smaller players compete.
So that alignment between the market's problems and Locafy's solution, that's a core part of the bull case.
Precisely. It's a core pillar of their investment thesis, yes.
Now, as a microcap, their brand recognition, it's pretty low globally, isn't it? Minimal institutional ownership.
Very low.
Yeah.
But within their niche, they seem to be building this reputation for, quote, deep technical expertise.
And cost advantages.
Their main claim there comes from that patented automated platform. They argue it lets them manage digital marketing assets much cheaper than the industry standard.
And the partnership model helps keep costs down too, presumably.
Right. Scales revenue without the same jump in fixed costs. And while it's early days, you can see the potential seeds of a network effect.
How so?
Well, the more channel partners they integrate with, the more they could become sort of the default technology layer for this kind of service. Plus, API integration creates some switching costs, albeit modest ones.
But their biggest competitive advantages, it seems, really boil down to their unique tech.
Absolutely. That core platform, patented back in 2016, built on their 8S framework: speed, schema, seamless, secured, structure, speakable, synchronized, scalable.
The statue?
Hey, yeah. But most critically, it's that AI-ready and entity-based SEO architecture. That strategic focus really aligns with how modern AI systems understand the world. It positions them right at the forefront.
And the fact they can demonstrate landing pages being cited by major AI platforms? That's powerful proof.
It's a very powerful proof point, and that fundamental architectural approach might be genuinely difficult for older legacy competitors to just replicate quickly.
Management evaluation.
Okay, let's shift gears and look at the people running the show. Management. Specifically, founder and CEO Gavin Burnett.
Right. He's been leading Locafy since day one back in 2009. So that's, what, over 15 years of continuous leadership, plus 23 years relevant experience overall.
And he's done this before, hasn't he? Entrepreneurial success.
He has. Crucially, he founded a company called Big Red Sky, built it up, and successfully sold it to Thomson Reuters.
That adds credibility. Building and exiting a tech company before.
Definitely. And the management team overall has shown some resilience. They navigated some serious challenges, NASDAQ non-compliance notices in 22 and 23.
How did they handle those?
Regain compliance through decisive actions, a 1-for-20 reverse share split, significant cost cutting, shows they can make tough calls, and the board seems seasoned too, providing decent oversight.
And they seem pretty active with investor relations, press releases, SEC filings.
Yeah, they maintain an active program, regular filings.
Uh-huh.
The CEO, Gavin Burnett, even pops up on podcasts talking to the investment community.
Which makes that decision not to name the partner in the big June 27th announcement even more, well, noticeable, doesn't it?
It really does. It brings up that transparency question again. There might be good competitive reasons, sure, but that lack of specific disclosure definitely introduces uncertainty. It's something any analyst would flag.
Okay, capital allocation. Where are they putting their money?
Primarily focused on investing in their core technology and also these strategic string of pearls acquisitions, small targeted buys.
Like Jimmy Kelly, digital for e-commerce SEO, 180-degree marketing for clients, Scoop digital assets.
Exactly. Acquiring expertise, client lists, assets to revitalize.
But no direct returns to shareholders currently. Dividends, buybacks.
No, none, which is pretty typical and frankly appropriate for a growth stage, unprofitable tech company like this. They need to reinvest everything.
What about return on invested capital, ROIC? That tells a story usually.
It tells a stark story here. Historically, it's been deeply negative, around minus 45.4%.
Ouch. So clearly the capital invested to date has destroyed value.
Unequivocally. But, and this is the crucial but, today's massive stock rally implies the market believes this new AI-focused strategy is going to flip that script completely. The belief is they can now generate a strongly positive ROIC going forward, one that significantly beats their cost of capital. That's the bet being made.
Financial analysis.
Right, let's dive into those numbers then. The financials. That partnership announcement clearly caused a dramatic re-rating.
Huge. Pre-rally, June 26th, market cap was tiny, about $3.52 million.
And post-rally, June 27th.
Based on the pre-market high, it surged to roughly $13.75 million.
Uh-huh.
And the volatility during the day itself was extreme.
Now, if we connect that surge to their historical revenue, it creates a bit of a conflict, doesn't it?
It really does. Looking back, fiscal year 2020 to 2023, they actually showed some compelling growth. Looked promising.
But then
Fiscal year 2024 hit, and that trajectory reversed sharply.
Yeah.
A significant 25.4% decline in revenue, down to $2.77 million.
that's a major red flag.
Huge. And it forces you to ask, was that prior growth just unsustainable, an anomaly? Or was the 2024 decline a one-off blip that this new partnership is genuinely poised to reverse? And dramatically so.
And profitability.
Deeply unprofitable. Negative margins right across the income statement. Operating margin minus 56.2%, net profit margin minus 58.1%.
Consistent net losses historically.
Consistent. Negative $1.996 million in 2024, for example. Just a history of losses.
What about cash flow, free cash flow, FCF?
Well, specific five-year figures aren't fully detailed in our sources, but the overall financial profile tells the story. FCF has been consistently and significantly negative.
Burning cash, not generating it.
Exactly. They've been dependent on financing activities just to keep the lights on. Their cash balance even dipped to a dangerously low $611,000 in March 2023 before they managed to replenish it.
And earnings, consistently negative too.
Yep, over the past 4 fiscal years, no clear trend towards profitability based purely on that historical data.
Okay, now, their reported debt-to-equity ratio is low, 0.14. That sounds good on the surface, right? Suggests a strong balance sheet.
It sounds good, but this brings up an important point. For a company with a history of accumulated deficits, that metric can be really misleading.
How so?
Because the equity part of that ratio, the denominator, is small and fragile due to those past losses. A much better view comes from looking directly at the balance sheet. Total liabilities, $2.85 million. Total equity, $3.31 million. So relative to their actual net worth, they are significantly leveraged.
And the current ratio, that measure of short-term health.
That's probably the most concerning metric right now. It stands at 0.92.
Below 1.0.
Which for listeners is a significant liquidity red flag. It means their current liabilities bills due within a year actually exceed their current assets, like cash and receivables.
So they might struggle to pay their bills over the next 12 months.
Potentially yes, without raising more capital. This underlying financial pressure, it makes the successful execution of this new partnership not just an opportunity for growth. It makes it potentially a necessity for survival.
Okay, valuation metrics. PE is meaningless with negative earnings. What about price to sales, PS?
Right. Based on that post-rally market cap of around $13.75 million and their trailing 12 months revenue of about $2.67 million, the PS ratio comes out at roughly 5.15x.
Which sounds high. For a company with declining revenue and negative margins?
It's a significant premium. Absolutely. It strongly suggests investors are basically throwing the historical performance out the window.
And valuing the company purely on optimism about the future?
Completely. Driven entirely by this new AI-centric narrative and the partnership potential. It's a huge leap of faith, isn't it? You, as an investor, really need strong confidence in this turnaround story to justify that premium.
So intrinsic value. We typically use a discounted cash flow, a DCF analysis, right? Valuing future cash generation.
We do. Though, given Locafy's history of negative free cash flow and all the uncertainty, pinning down a precise DCF value is really challenging.
But we can use an educational model to illustrate a potential range.
Exactly. Based on different scenarios. Our estimated intrinsic value range for Locafy looks something like this. A bear case, if execution falters, maybe $1.50 to $2.50 per share.
Fine.
A base case, assuming successful partnership execution, maybe $4 to $6 per share.
And the bull case, if they really nail platform adoption and market expansion.
Then you could potentially see $8.50 to $11 per share.
That's a very wide range.
It has to be. Is driven by some aggressive assumptions, especially in the base and bull cases. Things like really strong revenue growth in the next 5 years, banking on this partnership and maybe landing more like it. And we have to use a high discount rate, maybe 15 to 20%, to account for all those risks we talked about. Microcap status, unprofitability, huge execution risk, that customer concentration. Part 2.
Market sentiment.
All right, part 2. Let's pivot now from the company's fundamentals to how the market is actually perceiving all this. Market sentiment.
Okay. And the first thing to note is that Locafy operates almost completely under the radar of the professional investment community.
No Wall Street analysts covering it, no price targets, consensus ratings.
None whatsoever. Zero.
Which creates what? An opportunity and volatility.
Exactly. Opportunity for diligent investors who do the work, but also extreme price volatility because the narrative is shaped almost entirely by company press releases and, well, retail investor discussions online.
And the impact of that June 27th news was just immediate and profound.
Totally. Overwhelmingly positive sentiment shift driving that triple-digit gain. But as you'd expect, most of the coverage is pretty superficial, often just repeating the company's own press release without much independent critical analysis.
What about market indicators? Short interest.
That's a really critical piece of info here. The short interest in Locafy is exceptionally low, reported at just 0.08% to 0.12% of the public float. Tiny.
So what does that tell us about the rally?
It tells us definitively that this massive rally was not a short squeeze.
Right. Wasn't short sellers being forced to buy back shares.
No. The buying pressure came overwhelmingly from new investors taking long positions, suggesting a genuine, if highly speculative, wave of bullishness about the company's future prospects, not just a technical market blip.
And the current share price versus moving averages.
Currently around $9.96. That's dramatically above its 50-day simple moving average, the SMA, which is at $4.09, and way above the 200-day SMA of $5.91.
So a very strong bullish breakout signal.
Exceptionally strong. Indicates powerful positive momentum, which itself likely attracts more trend-following traders, adding fuel to the fire.
Ownership structure.
Okay, let's look at who actually owns Locafy shares. The ownership structure. Institutional ownership first.
Extremely low. Just 1.29% of total shares outstanding, which, again, is pretty typical for a company this size with its financial history.
How many institutions are we talking?
Only 4 on record. Morgan Stanley is the largest, but even they hold a tiny position. Just 17,700 shares.
So basically no real participation from the big professional investment firms.
Right, which means the stock lacks that kind of stabilizing influence you often get from a base of long-term professional investors.
But in stark contrast, insider ownership.
Very high, 19.1%. Founder and CEO Gavin Burnett holds the largest chunk, 10.7%. And the CFO, Melvin Tan, owns 5.4%.
Now, what's fascinating here, you mentioned insider trading activity, buys or sells.
This is really interesting. There have been 0 open market buys or sells by insiders in the past 12 months. 0.
So even with a one-day price surge of over 270%, the leadership team, who know the business best, didn't sell a single share.
Not according to the records. And that's a powerful bullish signal, isn't it? It strongly implies that management believes the intrinsic value of the company is significantly higher than even that post-rally price.
Wow. So the ownership structure is highly concentrated.
Ooh.
Insiders and the general public.
Overwhelmingly. The public owns nearly 80%.
And that structure, large retail float, low institutional presence, contributes directly to the volatility.
Absolutely. Makes it much more susceptible to big price swings based on news, narrative, and sentiment-driven trading.
Risk assessment.
Okay, now for a really crucial part of any deep dive, the risks. Let's frame this using a SWOT analysis: strengths, weaknesses, opportunities, threats. Starting with strengths.
Their core strength has to be that proprietary, patented, entity-based SEO architecture. It seems uniquely positioned for the shift to AI and conversational search.
Experienced leadership, too.
Yeah, experience and invested leadership. Burnett's track record, that high insider ownership we just discussed, and that scalable, capital-efficient channel partner model is a huge plus for a microcap.
Okay, weaknesses. What stands out?
The most significant weakness is undoubtedly its precarious financial health. That long history of substantial net losses, the consistently negative cash flow.
And that sharp revenue decline last fiscal year.
Exactly. All leading to acute liquidity risk, shown by that current ratio below 1.0. They might struggle to meet short-term obligations.
Plus, the lack of institutional validation, limited resources, only 26 employees trying to execute against much bigger rivals.
Right. It's a big ass.
Opportunities, though. They seem abundant.
They are. They're operating in that massive, fast-growing local SEO market. That 20% CAGR provides a powerful tailwind.
The new partnership itself is transformational, isn't it? Instant access to 10,000 U.S. users, upsell potential.
Absolutely. And the broader industry trends, AI, voice, hyperlocal search, they align perfectly with Locafy's 10 capabilities.
And this partnership could be a blueprint, replicated with others.
That's the hope, a scalable growth blueprint. Plus, their ongoing string of pearls M&A strategy offers a way to keep acquiring valuable assets efficiently.
Okay, finally, threats. What keeps management up at night?
Intense competition, first and foremost. Larger, better funded, more established players.
Execution risk. If this big partnership fails.
It would be devastating. Huge execution and reputational risk there. And tied to that is the customer concentration risk relying so heavily on this single, unnamed partner.
Technological obsolescence, too. Search algorithms change constantly.
Always a threat in SEO. And then macroeconomic factors. Economic uncertainty could lead to higher customer churn for SaaS subscriptions. A return to higher interest rates could dampen M&A and valuations.
And being an Australian company targeting the U.S. geopolitical risks.
Yeah, changes in U.S. law like Section 230, global economic instability impacting marketing budgets, even heightened cybersecurity threats. For a small firm like Locafy, a major cyber incident could be existential.
Conclusion.
All right, let's try and synthesize all this, bring it together. Let's recap the key bullish points for Locafy first.
Okay, the bull case really rests on the conviction that June 27th, 2025 marked a genuine, transformational turning point for the company. The strategic partnership acts as powerful third-party validation for their unique, patented, AI-ready technology.
Tech that's perfectly positioned for those big trends. AI search, voice queries.
Exactly. And the partnership itself provides this scalable, low-cost blueprint to enter the lucrative U.S. market. Immediate revenue potential from 10,000 users, plus those upsell opportunities.
Strengthened by experienced, founder-led management who've navigated crises before and have serious skin in the game.
Right. And that fact insiders didn't sell a single share into that huge rally. It signals a deep conviction from management that the company's true value is far greater than even the current market price suggests.
Okay, now paint the bear case for us.
The bear case is grounded in that stark, really troubling contrast between this exciting forward-looking story and the company's grim historical financial reality.
Financially fragile microcap, history of unprofitability, negative cash flow, weak balance sheet.
Highlighted by that current ratio below 1.0, signaling real liquidity risk. Plus, that sharp 25% revenue decline last year just calls the sustainability of any prior growth into serious question.
So from this perspective, the huge stock rally looks speculative.
Highly speculative, based entirely on a single press release about a partnership with an unnamed entity. That creates extreme customer concentration risk and raises those questions about disclosure transparency.
And they still face intense competition from much bigger players.
Right, well-capitalized, firmly entrenched competitors. Ultimately, the bear case just posits that Locafy's ability to actually execute on this new opportunity is entirely unproven. The risk of failure remains exceptionally high.
So bringing it back to valuation one last time, our educational DCF model gave that wide range.
Yep, bear case. $1.50. Base case. $4.06. Bull case. $8.50, $11 per share.
So where does that leave us?
Well, the analysis shows Locafy is at a critical crossroads. It's one of the purest examples you'll find of a high-risk, high-reward turnaround story. The partnership and the market's embrace of the AI story have created a credible path to significant value creation. It's challenging, but credible.
And the bull case aligns with the upper end of our value estimate, suggesting the current price is plausible if everything goes right.
Plausible. Under a best-case scenario, yes. The post-rally price around $9.96 fits within that bull case range. However, and this is crucial, the current market price appears to have already priced in a substantial amount of that future success.
Leaving a thin margin of safety.
Perilously thin. The stock has basically transitioned from what might have been a deep value play before the news into a high-stakes momentum investment now, driven entirely by that forward-looking narrative.
So for an investor looking at it today,
You'd need an exceedingly high conviction in management's ability to navigate all those challenges we discussed and actually deliver on the market's very lofty expectations to justify buying in at these levels.
and that's our deep dive into Locafy Limited, LCFY. We certainly hope this is giving you a clearer, maybe more nuanced understanding of this really volatile and intriguing company. Remember to like and subscribe to the stockanalytics.ai YouTube channel for more in-depth analyses like this one. And hey, for just $4.99 a month, members get priority deep dives on tickers.
That's right. And over the next few months, we're actually covering all of the S&P 500 stocks, and members get exclusive priority access to those.
Or if you just want a one-off deep dive on a specific stock, drop us a super thanks. We do pick those up.
And just a quick but really crucial disclaimer. This analysis was generated by an AI system. It's purely for educational purposes. It should absolutely not be considered financial advice.
Please, always conduct your own research or consult with a qualified financial advisor before making any investment decisions.
Definitely.
So wrapping up, what does this all mean for you, the listener? Maybe consider this. In an age where a single press release can seemingly trigger a 290% stock surge for a company that's been historically unprofitable, what does it truly take for a microcap to successfully pivot and actually dominate an emerging market segment like AI-driven search? And maybe more fundamentally, how do you personally weigh the exciting promise of AI against the cold, hard numbers of a company's past performance? Something to think about. We'll be back soon with another deep dive. Until then, stay curious and stay well informed.